The information contained in this podcast is an expression of opinion and does not constitute investment advice. This is the Gold Money Foundation podcast with Dominic Frisby, keeping you up to date with expert opinion on precious metals and the markets.
Now, it's my pleasure in today's show to be talking to Tim Price. Tim is a colleague of mine at Money Week. He writes for Money Week, and he's also a director of investment for PFP Wealth Management. Tim was giving an excellent presentation today at the Warwick University Investment Forum, and the title of that presentation, Tim, was Managing Wealth in Treacherous Times. And your opening slide was called The Long Emergency. So why don't we outline the subject of your presentation, and then we'll talk about some of the content.
I've been working for 20 years, and it strikes me in the capital markets, and it strikes me that we're in a situation that's unparalleled. It feels to me like we're at something approaching the end game for conventional economic and monetary history and for the financial system that we've all grown up with. The world has amassed too much debt. The Western economies in particular have amassed too much debt over recent decades. We have a global money and currency system that's not backed by anything tangible. And as a result, we feel there's a sense that just the wheels are starting to fall off the machine. There are any number of things to complain about, but I think it's really that the banking crisis that's now a global one is causing all sorts of people just to re-examine the fundamentals of investing. And our objective for clients is first and foremost just capital preservation, and that objective might sound modest in ambition, but we're finding it extraordinarily difficult to operate in these markets.
Well, capital preservation in 2011 would be deemed a good year, I suppose, if you ended the year with as much money as you began it.
Yeah, the phrase in the industry is "flat is the new up," so we'd be subscribers to that.
Very good. So. Your next slide was the developed world is bust.
Yeah, I think this gets to the heart of the problem that although the authorities can't say it, I mean, the authorities can't say that banks, for example, are insolvent, because if you even approach that territory, then it becomes a self-fulfilling prophecy. So everyone has to go through this charade that everything's orderly and move along, nothing to see. But you look at, to give you a sense of the sort of bizarre nature of the modern investment world, you look at the US. Now, the US has an on-balance sheet national debt of, let's say, $16 trillion. These are huge sums that are completely unbelievable sums that the human mind simply can't process. That doesn't even take account of unfunded liabilities. But let's just look at the sort of the official figure. So 16 trillion. That debt almost certainly is never going to get paid back. And yet, as far as international investors are concerned, US Treasuries are the safest haven in the world. If someone can explain the logic to me, I'd love to be able to understand it.
Well, behavioural mad fools.
Quite possibly, but it is staggering. So there's one quote that we use in the presentation that may have some bearing on the current situation, because we if nothing else, we have been here before. So there's a quote from Cicero that this was apparently dates back to 55 BC, and he said, "The national budget must be balanced, the public debt must be reduced, the arrogance of the authorities must be reduced if the nation doesn't want to go bankrupt." Now, I asked at Warwick here today, I asked if anyone in the audience was a historian or a classicist, and by all accounts, just about everybody in the room was some form of economist or studying economics. But the Roman state persisted, notwithstanding Cicero's concerns, for another 200 or 300 years. So the amazing thing about these dysfunctional markets and dysfunctional economies is that they can persist way longer than anyone expects. Another example would be the experience of the former Soviet Union, which, notwithstanding the fact that the whole model was broken and it didn't work and it was fundamentally corrupt, lasted 70 years before it completely imploded. So although we think the situation's quite grave, it could persist like this for quite some time, because you've got central banks printing money and printing money and printing money, and that can buy you quite a bit of time.
Yeah, and I would agree with that. And the policy of can kicking that
deafening.
Yeah. Now, I want to talk about your slide, what we know about bank crises, because that does give us a bit more timing of the kind of unfolding of all of this. So why don't we discuss, the timing of bank crises and what we know, and also, where that material was sourced from.
Sure. What's becoming a sort of seminal book of our times, analysis of our times for the financial crisis is Rogoff and Reinhart's study of fairly encyclopedic study of previous banking crises through history, and some of the statistics. And bearing in mind what seems to be the case is that most previous bank crises have been sort of localized, single nation, single country events. I think what's different about this time round is that we've rarely, if ever, had a banking crisis that's been so global in scale. So in other words, it's drawn so many different countries internationally from around and sort of polluted the well for all of them. But if you just take the Rogoff and Reinhart analysis that was published in 2009, on average, with a bank crisis, you have government debt rising to the order of about 90% in the subsequent 3 years. You have stock markets.
Okay, let me just stop you there.
Sure.
Government debt rises by about 90% in the first 3 years after the crisis.
Now that's on
happened.
average, and that's already happened. But although you've got some, if you like, notable exceptions and some sort of noteworthy exceptions, like maybe the UK, where the coalition is at least attempting to sort of massage down the debt burden through austerity, the much talked about, though perhaps not yet so visible austerity. The bottom line is that Europe in a larger context, for example, doesn't really seem to have grasped the nettle at all. Certainly European politicians don't seem to have done. So, if anything, debt burdens, notwithstanding the sort of the public iteration, the public rhetoric on the topic, is actually expanding still.
Okay. Next thing that happens in a banking crisis.
So that typically from the Reinhart and Rogoff study is you have a fairly significant bear market for stocks. So on their figures, it's something like a loss of 60% over the next 3 to 4 years. Again, these are average figures. And the reason we're concerned about capital preservation for clients is that we think this crisis is more significant in scale, in its fundamental essence, than what's gone before it. So the average figures may be understating the degree of pain that may still be to come.
Okay, so stocks lose 56% over 3.4 years. Now, if this banking crisis began in 2007 and the equity markets made their high in late 2007. I mean, we got that stock fall, but then we got this incredible rally from 2000.
Then we had sort of quantitative easing inspired recovery. And I think this also gets to the heart of the problem that you can describe as maybe the Greenspan put, that central banks feel obligated to support financial markets, specifically stock markets. So my thesis would be that the stock market never became cheap after the dot-com bust of, 2000, 2001. It should have done, but it never became cheap because then, the Federal Reserve slashed interest rates and in the process of doing so created another bubble in property prices, which then exploded and led to an even greater mess for everyone else to clear up. If the central banking authorities had moved aside and simply allow free markets to operate, then ideally we would have had a proper correction earlier in the millennium, and it wouldn't be in the state we're in. But as it is, the way central banks and politicians operate is that they always attempt to protect markets. We had that stimulus, quantitative easing it's been called, monetary stimulus, which buoyed stocks and led to a fairly dramatic recovery. But I would argue that now equity markets are probably, at least from a sort of UK and European perspective, they're probably delusional. Money printing is not wealth creation. Money printing is simply inflationary at its root. It is simply inflating the monetary base. That money tends to leak out quickly into the stock market. It's also leaked out into certain commodity markets as well. But the bottom line is, if the equity market, I don't think we're seeing a fair market. I don't think we're seeing a fair market in stocks or in bonds. Everything is being distorted through central bank policy. There's no fair market in anything, so it's very difficult to establish a fundamental value for more or less any financial asset now.
Okay, next point, unemployment.
Well, as we know now, as we can see just from the context of the UK, unemployment is on the up, and that's problematic to the extent of nothing else, that it's going to give rise to a higher welfare burden, a benefits burden. But from the Reinhart and Rogoff study, it's risen by something like 7% on average over, in their example, typically 5 years. Now, I don't think we're yet 5 years into this. I think that the crisis probably lasts longer because of the severity of the damage. That tends to suggest a particularly bleak outlook for employment here and in Europe.
Yeah, I mean, how much has unemployment already risen? And the problem with unemployment is a bit like inflation, is that the figures are massaged, so you don't really get a real figure. But how much has unemployment risen? Or, I mean, how much further have we got to go?
I think the process of adjustment is unfortunately, I think that process of adjustment has only just started. So, I don't know where we are now, but I can see as, just in the UK, the unemployment roster reaching 3 million again.
Okay, next one. House prices dropped 36% in real terms over 5 years.
Except in central London.
Well, I suppose we've had the house price drops in the States. That's, in a way, that's what caused the banking crisis, or they happened with each other. In the UK, what have we had? 15% falls from the 2007 high?
10, I'm led to believe.
10.
But probably this is worse to come.
But in central London, we've had 20% rises.
Yeah, central London does seem to be a sort of a rather unique state. But as we were discussing a little earlier today here at Warwick, the prime movers behind central London property would appear to be somewhat price insensitive buyers who don't necessarily even live in those properties most of the time.
They don't. I mean, central London is a ghost town at night. Nobody lives there. And, in fact, Jonathan, who I interviewed earlier, was describing some of the houses in central London that he's visited, and he just says they're empty inside. In fact, Jonathan's sitting there. Would you agree with that, Jonathan?
I would. I think it's very localized there. It's a big difference when you go from Chelsea to Knightsbridge into Notting Hill and out to Shepherd's Bush. It's a big difference. But yeah, the trend is very clear, and it's a whole number of people, different types of people coming here, people trying to escape problematic countries like Greece. I mean, a lot of Greeks have been buying London property as a safe haven from the impending euro crisis. It's just gradually it's hollowing out the middle of the very central part of London, absolutely.
I suppose the best thing that can happen to central London property in terms of if you want it to fall is a strong pound.
That wouldn't be front and centre of our investment thesis for the medium term.
In other words, you don't see a strong pound happening?
I don't see a strong pound happening. As we were discussing earlier, I think currency markets are a particularly difficult asset to call. But if one's going on the basis of debt loads and on the basis of likely economic growth, and also the fact that the coalition would almost certainly deeply value a weaker pound, if for no other reason than to help boost the fortunes of our much diminished export sector, we just can't see it happening. I think there's more, from our perspective, more reasons than not to be wary of sterling.
Okay, so next one, GDP falls. Why don't you read the next one out?
Yeah, GDP on the Reinhart Rogoff study typically falls by something like 9 to 10% cumulatively over the first 2 years. We've had that, and again, we've had some stimulus and we've had sort of a recovery, but it feels to us as if the UK is tipping back into recession or certainly very minimal growth. And I think also that a recession in the Eurozone is now more or less a racing certainty for 2012.
The average duration of bank crises.
Yeah, this is from a study from the Bank of England, and they studied 33 systemic crises between 1977 and 2002, can you believe? And this, I suppose, if there's anything positive from this, it's that if you've ever missed a bank crisis, you don't have to wait too long for the next one to come along. They're like buses. So average duration, 4.3 years. Again, our perspective would be that we're now, say, 3 or 4 years into this one, but because of the size of the mess, this is likely to be above average. So this one could yet last for a few more years, sadly.
Is there not an argument to suggest that this one is ending?
No, I see no evidence for that. I mean, we are, believers in the merits of gold for reasons of sound money, for inflation protection, particularly for currency protection in a world in which everyone's trying to depreciate their currencies. And we would argue that all of the fundamental reasons for buying and holding gold are even more pronounced now than they were even only a matter of months ago. The gold price, as expressed in nominal dollars, hasn't necessarily reflected that. But no, bigger picture, we'd still argue that the gold's best days are almost certainly ahead of it. Every reason for wanting protection against dark economic things, and particularly instability in the banking sector, those reasons are still very much there. And indeed, I think they've got worse over the last 6 or 12 months, not least in the context of the Eurozone crisis.
Okay, let's look at the next thing. This is again from the Bank of England.
So non-performing loans shoots up, and we've seen some of that, but I think again that there may still be more wood to chop on the part of the banks.
What does non-performing loans mean?
Well, non-performing loans, effectively loans that banks have made that they're not going to get, those loans aren't going to get properly serviced because the borrowers are basically at death's door or worse.
Okay, so are they going to get defaulted on, or
just has to be written off in some form?
Okay.
So, all of the statistics that the Bank of England has shown for average crises, we've probably seen at least as bad over the course of the last few years. But for us, there's no certainty that this is automatically been rectified. The difficulty in terms of investment markets is that we can't really trust the banks because these entities have been deemed too big to fail. We'd nurse the concern that the UK, with the likes of RBS and Lloyds, is replicating the example of Japan, where you have zombie banks that instead of being put to the sword or fully nationalized, just inhabit this sort of middle ground where, they're getting stimulus money coming in at the top, but they're not willing to lend it out to SMEs or to households.
And households don't even want to borrow.
And the
anyway.
households probably don't want to borrow because they're more interested in paying down debts. So, the banking system, the monetary system is broken. It would be better for more or less everybody involved, apart from the bankers, to put some of these zombies just out of everyone else's misery.
What about if you have money with the bank and this bank was put to let go the way nature wants it to go?
Well, there's a difference between depositors and shareholders, and bondholders for that matter. I think in a fairer world, then, again, there's something artificial about, having these businesses persisting as listed businesses, as equity businesses, because I'm not sure the businesses are worth anything in some cases. So what I think would have been altogether fairer for everybody, particularly the taxpayer, would have been for those banks that are functionally insolvent to be nationalized. Equity holders and bondholders get wiped out, but depositors still have their money effectively underwritten or guaranteed by the government.
Okay. Cumulative fiscal costs of banking resolution are whopping 7.8% of GDP without currency crisis, or 17.4% with.
Yeah, I think we can agree that, again, historically it's been a bad experience, and this time around probably going to be worse experience than average. That the last of the Bank of England figures that we quote is that 2/3 of all banking crises result in a currency crisis. Now, in the terms of the Bank of England study, that's defined as a 25% fall against the dollar. But we would argue that as and whenever the Eurozone ever gets its act together, then the pendulum of investor interest swings to the States, which is also the proximate cause of the crisis to begin with. So, firstly, I think we will see, again, ongoing depreciation of currencies. But I don't think that ends in Europe. I think that goes on ultimately to the US dollar itself.
Now, but the pound has already fallen by 25% against the US dollar. So we've had that.
We've had it, but there's no automatic reason why we don't get a bit more. And as I say, it's in the interests of the government and many exporters to see a weak sterling even from this point.
Okay, I'm not as bearish on the pound as you are, but there we go. Now, let's come to this next chart. We've only got a couple of minutes left, Tim, but you describe this chart as the most important chart you'll see this year. Now, let me just describe it for those listening. There's a horizontal line that represents naught, and on the left-hand side, above the horizontal line, are various countries, and on the right-hand side, below the horizontal line, are various other countries, and in the middle, kind of just below the horizontal line, are a few other countries. Now, you're going to describe what that horizontal line is and what it means and how it determines how you should be investing.
Sure. In a nutshell, the chart shows you net foreign assets of number of countries as a percentage of their size of their economy. So there are countries out there. What is net foreign assets? Net foreign assets is the totality of government plus corporate plus household assets. And why are we looking at foreign assets? The best example to use is the UK itself. The UK will never realistically struggle to service its sterling-denominated debts because it can always print more. Now, that's fine for sterling, though not. Well, this is fine for sterling in the context of bondholders or for the Bank of England, but it's a problem when we've also borrowed in other currencies. So the UK's borrowed in dollars. Since we can't print dollars, it's important that we have a variety of foreign assets as part of our sovereign balance sheet to tide us through times when, for example, we've got foreign borrowings. So if you look at net foreign assets for any country, they show you probably more representatively how creditworthy those countries are. And the bottom line is that there's a small number of highly creditworthy countries in the world that have huge surpluses of net foreign assets. And those are countries like Singapore, Hong Kong, the United Arab Emirates, Qatar, and so forth. And then you've got Norway's in there as well. Switzerland's in there as well. And then you've got a middle ground where you've got small liabilities, but not huge, but small liabilities. That includes the UK and the US. And then you've got a rather more desperate sort of basket case number of countries where they don't have net foreign assets at all. They only have big net foreign liabilities. And we'd argue those countries are the sort of countries where you simply don't want to be lending money to them or holding their debt.
And tell us what those countries are, or some of them.
Well, to give you an idea, and some of these we know historically already the case, but I mean the far outlier on this chart is Iceland, but we know that's got problems. The next one along from Iceland is Greece. Enough said. But you've also got countries there, a lot of Eastern European countries.
I was surprised to see New Zealand.
New Zealand and Australia are there. Yeah, New Zealand often takes people by surprise. I'm no expert on New Zealand, but I suspect that may reflect that New Zealanders simply have been unable to run a balanced budget for a long period of time.
Okay, and we should be buying the bonds and the currencies of those countries that are above the line.
Absolutely right. That's our base case thesis. So we would argue that in a deleveraging world, money is going to flow from the poor quality debtor nations to the high quality creditor nations. So if you were going to trade this from the perspective, say, of a hedge fund, of a long short fund, then you'd basically be buying the Singapore dollar and you'd be shorting, if not the euro, then maybe currencies like the Turkish lira.
Very good. Okay, Tim. Well, it's been a real pleasure talking to you, and it was an excellent presentation. And is there anything else you want to add from the second half of your presentation? We've talked for a while, and I mean, you were kind of very pro gold in the second half.
Yeah,
of your presentation.
The only thing I'd add for anyone that doesn't have gold is to have some gold, because it probably is the finest currency to hold right now at a time of widespread currency debauchery.
Very good. And Tim, do you have a website that the name of which you'd like to give out if anyone wants to get in touch with you?
There's the company website, which is www.pfpg.co.uk. That's probably as good as any.
And why don't you give your newsletter a plug as well?
Yeah, I do. I do a fortnightly subscription newsletter called The Price Report, and that's done in conjunction with Money Week.
Very good. Well, Tim Price, thanks very much for talking to us with such great lucidity and passion and doom and gloom. Tim Price, thank you very much.
Thank you.
Subscribe to the Gold Money newsletter at www.goldmoney.com to receive email updates on new articles, videos, and iTunes podcasts from our Gold Research section.